Good morning and welcome to this latest Scottish Fiscal Commission webinar. Today's webinar relates to the forecast we published on the 31st of May to accompany the Scottish Government's spending review and its updated medium-term financial strategy. I'm Professor David Alf, one of the commissioners of the Scottish Fiscal Commission, and I'm very pleased to be here and to be joined by my fellow commissioner, Professor Francis Breeden, by our Chief Executive, John Ireland, and by our Head of Economy and Tax, David Stone. The format of this webinar is that Francis will shortly give a presentation setting out the main features of our forecasts. After that, we will have a Q&A session, which Francis, John, David and I will try to answer your questions. We aim to finish around 12 o'clock. This session is being recorded and will be uploaded to our YouTube channel later on. Audience members can ask questions at any time by going to slido.com and entering the code 33841116. So that's slido.com and the code is 33841116. This information will remain on your screen throughout the session. If you see a question that you really like or had thought of asking yourself, then you can upvote it, and that will increase the chances that the question will be put to us. If you wish us to say who you are and possibly which institution you're from, then please add this information to your question, but there is no obligation to do so. As I said earlier, today's webinar relates to the forecast we published to accompany the Scottish Government's spending review and its updated medium-term financial strategy. The spending review covers the next 4 years and the medium-term financial strategy the next 5 years. That longer-term perspective is a vital one for thinking about Scotland's public finances and one to which we have made an important contribution. Our independent 5-year economic and fiscal forecasts provide an understanding of the funding position, while our 5-year forecasts of Social Security spending set out the profile of a key area of spending. Together, these set the constraints on all other areas of spending. Scotland continues to be affected by challenging economic circumstances and uncertainty. Rising inflation means earnings aren't keeping pace with the cost of living. We expect inflationary pressures to last into the middle of next year, with a return to positive real earnings growth in 2023-24. This economic outlook feeds through into the Scottish Government funding position. Overall, we're expecting total funding to drop slightly in real terms for the next 3 years, before increasing somewhat towards the end of the 5-year period. Social Security spending will account for an increasing share of the resource budget. In 2022-23, Social Security accounts for around 10%, but by 2026-27, we expect it to have increased to around 14%. When our forecasts for Social Security spending are added to the government's own plans for health and social care spending, the funds left for other portfolios are very constrained. Once adjusted for inflation, funding for these other areas falls substantially for the first 3 years of the spending review and is 8% below the 2022-23 levels by 2025-26. In 2026-27, funding is expected to be 5% below 2022-23 levels in real terms. Following these brief contextual remarks, let me now hand over to Francis to give his presentation. Please remember to submit any questions you have by going to slido.com and entering the code 3384116. Francis, over to you.
Thanks, David. Yes, as you can see, that Slido code is down on the bottom of each of these slides, so you can log in when you think of a question or even before. Okay, so what I'm going to do is really pick out three themes from our forecasts and go into them in a little bit of detail. So the first one is about the economic outlook, and as you all know, I mean, the key consideration here is the rise in inflation and the impact of energy costs and other costs that are coming from overseas. Then I move on to look in more detail at the tax and funding, and I'll tell a rather long story about tax and funding and where it all comes from. But the bottom line is basically that over the next 5 years, funding is broadly stable in real terms, so not really much of a real terms rise, but roughly stable. And then the final point, really, which is David's already mentioned, is in the background of a stable funding situation, the fact that the Social Security spending is forecast to rise significantly means that there are reductions in spending elsewhere, and I'll go a little bit into the detail of how those work. Okay, so those are my three themes. So firstly, economic outlook. So this really summarizes the situation, and in particular, comparison with our December forecast. So compared with our December forecast, we now see a significant rise in inflation. Obviously, that's mainly related to the impact of the Ukraine war on energy and other costs. There was already some supply chain issues already in December, and those have continued. Now, that rise in inflation, we, like other forecasts, expect to be relatively temporary in the sense that although those costs have risen significantly in the last year or so, we don't expect necessarily further rises. We just expect these costs to remain elevated. However, one obviously important thing about this inflation that's coming from overseas price goods is that it really, almost by definition, has to make us poorer, that we have to spend a bigger part of our budget as a country on things that are coming from overseas. And so what we effectively see is that rise in inflation is not matched with rises in real earnings. So you get a fall in real earnings, particularly in the short run. So as you can see, compared to December forecast, we now expect almost a 3% fall in real earnings coming from those higher costs. So that obviously has, as well as the inflation itself being creating some nominal changes, this is also where real impact of these events are hitting home. So to summarise, this is our forecast comparing December with May, and you've seen both the real earnings and the CPI numbers already. The only other numbers we look at is the GDP, where we expect that fall in real incomes to be spread over a number of years. So we see lower growth for a number of years as people effectively smooth that big shot to real earnings over a number of years. Okay. Now, as I said, this is a period of great uncertainty. How far the price rises will be, how big the real income falls will be, are very uncertain. So this is a particularly uncertain time for forecasters. But as is often the case, when things are most uncertain, forecasters sort of huddle together for warmth. And so you see here that our forecasts for Scotland compared to Fraser-Vallender, but also compared to UK OBR, National Institute, Bank of England, and the Treasury average of forecasts, they all look relatively similar. But I re-emphasize that doesn't mean to say we all are pretty certain, that there is a rather low risk around these forecasts. I think every forecaster would say the risks around their forecasts are particularly large. It just happens to be that we have rather similar forecasts, and so real only a slight outlier is the Bank of England that has a mild recession in 2023 when most forecasts are expecting a little bit of growth. Okay, so that's the economic outlook. Now let's get into the nuts and bolts of tax and funding. So this chart is of the income tax net position. So what that means is, as most of you know, the fiscal framework, there is what's called a block grant adjustment. Basically, what happens there is that funding for the Scottish government that would have come from the Scottish share of UK-wide income tax is taken away from the block grant and replaced, in essence, by an estimate of actual income tax collected within Scotland. And what this net position shows you the difference between that block grant adjustment, the Scottish share of UK-wide, and the actual income tax collected in Scotland. And you can see, particularly looking at the blue line, which is our current forecast, you can see that that position is negative, i.e. that there is less income tax being collected in Scotland than is being taken off the block grant. And so that creates a quite tight funding position in the early years. Then you see a big flip round of that position. So suddenly the net position improves again. And that's due to two reasons. The key one is the UK government's commitment to cut the basic rate of income tax to 19p, a commitment that has not been matched in Scotland. And therefore, effectively, what happens is there is a cut in the block grant adjustment because there is less income tax being collected in the UK. And that cut is not reflected in income tax revenues within Scotland. So the net position improves. The other reason that net position improves is a sort of technical adjustment we've made to what's called our baseline. We now assume that the higher rate tax threshold will not rise with inflation. So historically, we used to use the idea that the thresholds would rise with inflation. We've taken that assumption away now. We just assume that the thresholds are fixed. And the reason we've done that is really summarized in this chart, which shows you the grey lines are our forecasts of what would happen to the tax thresholds, higher rate tax threshold, and the yellow line is what's actually happened. And as you can see, we continually expected those thresholds to rise with inflation, and they really haven't. And therefore, we've made consistent, effectively forecast errors by assuming that rise will happen. And so we've decided to change that in agreement with the Scottish Government to assume that the higher rate threshold will be fixed in nominal terms, which we hope is a sort of more realistic baseline assumption. Now, clearly, that change in assumption effectively generates more expected revenues for Scotland as more people enter the higher rate if the threshold doesn't rise. So those two changes, the 19p cut and this higher rate change, is the reason why the income tax net position that I showed in the previous chart improves in the out years. Now, as almost required of all forecasters, we have a quick look at house prices. Really just to highlight here that whereas you might think in a period of high inflation, we would have revised up our house price forecast, house price growth forecast. In fact, we've revised it down, and that's basically with the idea that more people's budgets are being spent on things like energy and food, and they have less to go on housing and rent, and therefore that will create a squeeze on house prices. As you can see, we're not doing anything dramatic. We're not saying house prices are going to fall. We're just saying that they're not going to rise as fast as we expected in December. The other reason I highlighted that was just to note that the other tax positions related to land and building transaction tax and landfill tax, they don't have that extreme movements the income tax net position does. So they are roughly near zero or slightly above zero. And therefore, the big swings in the net position are all coming from the income tax side. Now, we'll come to the thorny issue of reconciliation, something that we've talked about several forecasts. Just to try and explain, but as you already know, is a little bit of a complex area. But the basic idea is that both that block grant adjustment I was talking about and the income tax revenue for Scotland, they are both for a given budget, they are both based on forecasts, that the OBR forecasts the block grant adjustment, and we forecast the expected income tax, and that's the basis on which a budget is created. 2 years down the line, the actual data for both those things is finalized. And so there is a part of the framework that says, well, if the net of those two numbers was forecast incorrectly, then the Scottish Government either has to pay back the extra money that it received, or indeed receive some extra money if it received less than it should have done. Now, here you can see there is a very big reconciliation coming in 24-25 relating to the budget of 21-22. That was, as you recall, of 21-22, a very uncertain time due to the pandemic. Both we and the OBR under forecast income tax revenue, and we both revised up our forecast, but the OBR's revision upwards was significantly greater than our revision upwards, and therefore effectively the block grant adjustment was revised up a lot more than the income tax line, resulting in this very large negative reconciliation, minus 817. And it's worth highlighting because that reconciliation is larger than the borrowing powers and that the Scottish Government has to smooth those reconciliations, and therefore there will have to be some real cuts in order to pay for that, pay back that money that was effectively extra money that was received in the 21-22 budget. Okay. So now to sort of go through the whole funding position, you'll be pleased to say I'm not going to go through every line of this table, but I am going to highlight a couple of things because they are going to be areas that we at the Commission are going to be looking at, scrutinising quite carefully in future years. The first one I want to highlight is this line called expected future consequentials. So there has been a long historical pattern whereby the amount of funding that's been delivered in a spending review has actually not been as much as has finally arrived, in a sense that, so for example, if the UK government announces a policy change that in essence will deliver some funding to the Scottish Government, that will raise extra consequential funding for Scotland. And we've observed historically that has been pretty much consistently the case, that there have been extra policy announcements or extra policies going through the works that result in extra consequential income for Scotland. However, this is the first time that the Scottish Government has decided, in a sense, to put those consequentials in the bank without necessarily attaching them to a policy. So the assumption now is we don't know quite what policies are going to generate these consequentials, but given the history of extra funding, we are going to assume that extra funding will continue in the future. We, as the Commission, feel that's a reasonable assumption on the basis I've just said, that seems to be the historical experience. But clearly it is a step further down the line of making assumptions about funding that might not necessarily come true, and therefore we're going to be keeping an eye on how well that assumption performs and whether it needs to be thought through again. Second line I want to quickly highlight is the ScotWind proceeds. So as you probably know, there was a sale of leases for offshore wind already, and that generated £660 million, which the Scottish Government has the option of dipping into over time. The Scottish Government decided to effectively take that money in the first 2 years, 22-23 and 23-24, and then not have any for future years. We can see why they've done that, because as I showed you a moment ago, the first 2 years of funding are particularly tight, and therefore this money is particularly to be welcomed over that period. And indeed, keeping the money in the bank, it's a non-interest-bearing bank account, so it's probably not sensible to keep it in the bank indefinitely. However, it is slightly a shame, because clearly that funding could be used to add flexibility to future budgets, and so the fact that it is used up within 2 years means that the flexibility afforded by spreading those receipts over several years is quickly used up. But we feel that's a reasonable thing for the Scottish Government to go done, given the the other factors I mentioned. The final line I want to highlight is this reserve drawdown. the sharp-sighted view will have noticed, how can there be a reserve drawdown every single year of the forecast, given that that reserve is not a lot of money and clearly can't be sustained with that level of drawdown. Effectively, what the Scottish Government has done is rather similar to the future consequentials. It is observed that there is now a pretty long history of unplanned underspends by departments, which effectively get put in the reserve. And so at the end of it, each year there are this extra money gets put in the reserve and has been drawn down in future years. So again, what the Scottish Government has done is effectively said, given that long history of underspends, we are going to assume that underspends continue in the future, and therefore that will give us effectively some extra funding for future years, because those underspends can be drawn down from the reserve. So again, rather like the consequentials, we think that's a reasonable assumption, but it is very much an assumption and something that we're going to be keeping an eye on. Okay, so that's the long story. To give you the short story I've already given you, what's the overall funding position? As you can see in nominal terms, which is the blue bars, it rises significantly. But in real terms, the yellow bars, funding is pretty much stable over the forecast period, falling slightly in the early years and then rising towards the end of the period. But effectively an overall stable real funding position. Okay, so now that really brings me to my final point, which is the balance of spending given that funding background. And something that regular viewers will know, we talk about a few times now, is the fact that Social Security spending is forecast to rise significantly relative to available funding. As you can see, about £500 million in 22-23, and then rising to 1.3 billion by the end of the forecast period. And that's a combination of new Social Security policies announced by the Scottish Government, but also a significant part is due to the Scottish Social Security Scotland's commitment to have a more sort of accessible and easy to use Social Security system, which we expect will result in higher take-up of existing benefits. So that funding, that extra money has to come from somewhere, and what this penultimate slide shows is how that's divvied up. So as you can see here, at the bottom here, the grey bars are the spending on Social Security, and as David already mentioned, rises from about 10% of the budget to 14% of the budget by the end of the period. We've added health and social care, which is been a commitment to rise, as shown here. And we really like to highlight that the squeeze comes in the non-health and social security, non-health, social care and social security areas of the budget, where you can see about half the budget in 2023 went on those areas, and we're expecting it to shrink significantly over the next few years. So that's, as David mentioned, that effectively means an 8% real cut in funding to non-health, social care and social security spending. So that's really where the spending review has bitten down hard. Okay, now you've all sat there very patiently thinking about the 3.5 billion funding gap, and I haven't mentioned it all the way through until my final slide. But I'll try and explain where that is. So as a lot of you have seen in the news, there's been discussion of this 3.5 billion funding gap, and that's related to a comment piece recently published by the IFS. So what does that refer to? Well, it refers to some modelling that the Scottish Government did in the December budget in the medium-term financial strategy. So it's the Scottish Government modelling scenario, not ours, but effectively what it was trying to do was say, if all spending commitments or aspirations, I should say, were fulfilled, what would happen to funding? And it came up with the fact that there was simply not enough money for all those funding aspirations to be fulfilled. So where's it gone? Where's the 3.5 billion gone? Well, it's gone in the way I've just described, those spending aspirations have been, relatively speaking, significantly cut back. That obviously, particularly in the non-social security, non-health area, there are significant cuts in real funding coming to those areas, and that will effectively closes that funding gap that that was sort of notionally there, given this modelling that was done there in the past. So, in a sense, the $3.5 billion is a bit of a yesterday's story. In a sense, today's story is really the way that the spending review has made sure that the budget does balance and there is no spending gap, and that's what's happened in the spending review. Okay, so that's me. You'll be pleased to hear. Just to remind you again, there's slido.com and the code there. So I'll hand back to David, who hopefully will pick up the Q&A. Oh, you're on mute, David.
Thank you very much, Francis. Yes, we have quite a number of questions coming through. So the first question is, how can prices keep rising when wages don't keep up? When will inflation come down? Okay, let me try to give an answer to this question. There are two factors which are driving the inflation we've been seeing over the last year. One is that as economies have come out from the recessions and from recovering from COVID, there's been a huge increase in demand for things like energy as businesses have started to get back into business. That's also been met, though, by supply chain disruptions. There's been the Russian invasion of Ukraine. There's been supply chain disruptions from China as they've tried to control COVID by lockdowns there. So these increases in demand have been hitting shortages in supply. And that's been what's driving up prices. And a lot of this stuff is coming from imports. So it's not just demand in this country, it's demand across the world that's been driving up these goods which are being imported from across the world as well. So that's why there are pressures to drive up prices, even when wages in this country are not keeping pace with that. When will inflation come down? Well, in our forecast, we're forecasting that inflation will fall back down towards the 2% level by next year, 23-24. That, I think, is one of the big downside risks in our forecast. The risk that's in our forecast is that we might end up with a wage price spiral, so that increase in prices start to drive up wages. Those increases in wages drive up prices again. And we get back to the kind of thing we used to have in the 70s and 80s with wage price spirals. At the moment, we're not forecasting that. At the moment, we think inflation expectations have been fairly well anchored by a couple of decades of low inflation, and that this wage price spiral may not kick off. But that is the big risk to our forecast. Okay, we have a second question is, with the ONS today reporting real terms pay falling by 2.2%, have concerns about a wage price spiral being overblown? Well, I've made some comments on that, but David Stone, do you want to add anything?
Yeah, I think we always knew that real earnings were going to fall this year, so that result from the ONS isn't unexpected. I think the concerns about a wage price spiral would come in over the next year if we do see pay settlements start to rise up, irrespective of what's happening with import prices, and perhaps people start to lose confidence in the ability of the Bank of England to bring inflation back under control, and they start demanding sort of higher pay rises at the same time. That's when a wage price spiral would start to take off. So I don't think this latest piece of ONS data really tells us that it's definitely not going to happen. But as David said, it's not part of our central expectation at the moment. I see Francis is not online. I don't know if Francis.
Yeah, no, I think you're exactly right. I think the point here is, as I mentioned in the presentation, we are going to, because of these rise in import costs, we are going to end up poorer, and you can fully understand why people will want to resist that that outcome and ask for wage rises that compensate them for those higher import costs. Sadly, because it's imports, the money is not there to pay those higher wages. So it's a difficult time for everybody, because we're effectively saying external events has made us all slightly poorer, and we have to effectively take that on the chin, because there's no simple way out of it.
Okay, thank you very much. Our next question is about income tax. So why is income tax revenue growth lower in Scotland than in the rest of the UK? Well, I'll start off answering this, but I'll maybe pass it on to others to pick up other points. We've been looking into this quite a lot. There are a number of issues we've looked at. There are both regional and sectoral factors at work here. So, for example, when we look at the northeast of Scotland, it just looks as if earnings have been growing much more slowly there than not just in the rest of the UK, but in the rest of Scotland. And that's just as the oil industry, the onshore parts of the oil industry, are starting to go into decline there. Of course, there is talk about trying to get fuel security, and maybe there'll be some resurgence in the northeast. But our view is that the long-term decline in the northeast is an ongoing pattern. Also, if you look sectorally, what's driving up wages or earnings a lot in the UK is very rapid growth of earnings in the financial sector in the southeast, particularly around London. And Scotland, although it has an active financial sector, we don't see quite the same rate of growth of income in the financial sector in Scotland as we are in the rest of the UK. There are other demographic reasons. We have a more aging population, and we've observed that the participation rate amongst young people in Scotland is not only lower than in the rest of the UK, but it's been falling. David Stone, is there anything else that you'd like to add to that?
I think David's identified all the factors there that we've looked at so far, and I think that's the unfortunate thing for Scotland, because it's not just any one thing that might be fixed or might change, but there does seem to be several different factors, all of which have contributed to Scottish income tax revenues growing more slowly than in the UK, which is what results in the negative net position that you saw in the charts that Francis was showing. So the really big question is, that's what we've observed over the last 5 years since income tax was devolved to Scotland. What does it all mean for the outlook? Which of those factors might start to move in the other direction, and which of them are more baked into the system and might continue to cause a drag in Scotland in the coming years? And that's exactly what, sort of as a plug for a future paper, we're going to be trying to disentangle some of that and try and look at some of these factors in more detail to think about how they've contributed in the past and how they might contribute in the future.
Okay, thank you very much, David. Our next question is, why are real earnings falling when unemployment is at a historic low? Francis, do you want to pick up on that one?
Yeah, I think that's a good question, and I think if you're as old as me, you remember the 70s and 80s, and how the labour market squeezes really pushed up earnings growth and inflation. You would say, well, in this combination of low unemployment and rising prices, we would expect earnings to keep track, and we'd expect a significant rise. I think, as David says, I've said, we've now been through so many years of zero or almost no inflation that expectations are much more anchored than they were historically, and therefore there isn't that natural knee-jerk rise in earnings. And of course, as I mentioned, the real earnings cut is coming because of the cost of imported goods. So it's sort of there. It'll happen one way or the other. The question is whether it results in a long period of earnings trying to keep up and not managing, or whether it's a one-off, which is roughly what most forecasters are assuming at the moment, that the real earnings hit happens straight away, and then we sort of go back to a low inflation environment.
Okay, thank you, Francis. Our next question is about LBTT. So the question is, on LBTT and house prices, are the Commission assuming a 0.25 percentage point increase in interest rates? Would steeper rise in interest rates, for example, 0.5 percentage points, impact forecasts negatively? David Stone, do you want to pick up on this?
Yeah, so we do assume a rise in interest rates in our economy forecast in line with the OBR. And that certainly entered into our thinking around house prices and was one of the factors around us bringing down our house price growth forecast slightly despite rising inflation in the economy. So it's sort of there and in the background. I think the real question is, what if the Bank of England increases interest rates even faster and more sharply than we're sort of already accounting for in our forecast? And yes, you're right, that would have probably a further negative effect on house prices as mortgage costs continue to go up.
Okay, thank you. Our next question relates to Social Security. So the question is there any modelling on the long-term economic benefits of the £25 a week child payment for under 16s? I'll start off with this one, and maybe somebody else can come in. The answer is we haven't actually done that modelling explicitly. We know it's an issue that has been on the minds of a number of MPs. Our view is that just Social Security itself is something which benefits a lot of people in the economy, and that can have many different effects. But given that a lot of that benefit, the majority is going to disability benefit, it's harder to see how that's going to have much of an impact on the economy other than through the benefits it confers to the people receiving the benefit. So yes, there's an issue there, but no, we don't actually explicitly model the long-term impact of any of the benefits, including child benefit. I know, John, do you want to come in and add anything on that?
Yeah, I think just to reinforce your point, David, that our job is very much to forecast the payments, so that's what we focused on. For the government in introducing these payments, there's a very clear case based on relative child poverty and their child poverty targets. So there's a case about sort of what sort of society do we live in, and obviously a society in which there's less child poverty is a good society. But there is also a sort of a strong economic case, which people often make, that if children grow up in sort of households which are not as poor as other would be, they have greater opportunities, that they're as well as being sort of happier and more resilient, that the children who come through that sort of environment will be have better education and be more able to make an economic contribution. We certainly haven't modelled that. It's sort of not core to our job. I'm trying to think of other people who may have done that, and I'm personally not aware of any particular work on Scotland for that, although I'm aware of quite a lot of evidence at a UK level which sort of talks about the benefits of sort of early intervention and making sure that sort of children grow up in sort of in circumstances which are sort of better than they would otherwise be.
Okay, thanks very much, John. Our next question comes from David Lonsdale from the Scottish Retail Consortium. He's asking about NDR. So he's asking, what are our forecasts for NDR? Conscious we are moving to 3-year revaluations. Also, the Scottish Government Spending Review penciled in a rise in the poundage rate next year. So there's quite a lot of different issues there. I'll start off and then I'll hand it back to David Stone. So briefly, what we're doing is we're forecasting that NDR will fall a little bit because of a rise in appeals losses. We're just looking at the data and seeing that appeals losses are running at about the limit of what we previously assumed would be taking place. So we've increased our assumption about appeals losses. But then inflation kicks in, and that causes NDR to rise in the future. David, do you want to add more to that?
Yeah, so I mean, there's quite a bit going on with NDR at the moment, with the new revaluation coming in next year, moving to a 3-year revaluation cycle, and as David mentioned, there's also a change in the way the appeals process works. So we discussed that a fair bit in the chapter, and obviously provide the the exact forecasts alongside that. As David mentioned, we've changed one of our assumptions about the loss to appeals, which has brought down our forecast a little bit. But at the same time, they're increasing, at least for the first couple of years, as the retail, hospitality, and leisure reliefs come out of the forecast. So that drives them up quite a bit. And then later on, we've got inflation driving up the forecast too. So a lot of different factors in the mix there. You mentioned poundage. We have a simple baseline assumption that poundage will go up in line with inflation. That's long been part of our forecasts. Obviously, in reality, the Scottish government chooses how to set poundage itself, and it may well choose to do something different to inflation. So us obviously moving poundage up in line with inflation right now is a sizable increase, but that that it doesn't indicate what the government's necessarily going to do in practice when it comes to it.
Okay, thanks so much, David. Our next question is about modelling in general. So the question is, modelling different scenarios and being open about assumptions is critical. Were you disappointed in the clickbait comment piece from the IFS rate the spending gap? Francis, do you want to respond to that?
Yeah, I can't give this one a try. I mean, no, I mean, I think it was actually a good comment and reasonable comment. It was in the MTFS. I think the slight surprise to us was that it's been, these numbers have been there since December, and they sort of emerged just before this budget and have caused a little bit of confusion as to what they relate to. But I think, as you rightly say, modelling scenarios is important, and I think the IFS reasonably highlighted this as an issue because, as you saw in the forecast, in essence, it did come into the forecast. It came in through that significant cuts in spending in certain areas that probably weren't the things that the Scottish government wished to do in December, but have now effectively faced up to because the spending review has no funding gap in it.
Thanks, Francis. Let me just add one point to that, is that the IFS article said that the Scottish government essentially had two options, tax or axe. And if you look at the forecast we've produced, as Francis brought out in his slides, actually the response has been a combination of the two. So taxes are going up in this because of, first of all, our assumption about the higher rate threshold being held fixed in nominal terms. We also benefit in terms of the cut in the OPI in the block grant adjustment because of the cut to 19p in the rest of the UK. So there's extra tax revenue coming into Scotland for those reasons. But at the same time, as the slides made very clear, there's a big fall in spending in areas outside social security and health. So it's a combination of taxing and axing that's taking place. And the Scottish government has been very honest about what's going on there. Okay, so the next question is about inflation. So the question is, would higher inflation not cause higher house prices also? David, do you want to pick up on that one?
Yeah, I mean, sort of all else equal, if inflation is coupled with higher earnings, then that eventually may feed through to higher house prices. But there's an awful lot going on at the moment apart from just inflation. And sort of as we said in the report, we're obviously looking at what's happening to household incomes, disposable household incomes, and also interest rates, and they have a negative effect on house prices in our forecast. If we do get to a point where there's rising inflation coupled with a wage price spiral and earnings start to go up, you might see some of that feeding into house prices, but that wasn't where we are right now. That wasn't part of our forecasts.
Okay, so our next question is Scotland fiscally worse or better off because of devolution? John, do you want to pick up on that?
Yes, I had a feeling that might be coming my way. I think that in December we published a chart which could be interpreted to sort of say, well, look, if you just looked at income tax in isolation, there was you could read that into the chart. I think that would have been an incorrect reading because at that point the baseline assumptions of the OBR, which determines the block grant adjustment, and our baseline assumptions were out of line. So I think that would have been an incorrect reading of the chart at Christmas. And at the moment, we're not saying anything about this sort of this issue. The work that David Stone talked about may help to sort of untangle some of those sorts of things later in the summer. But of course, we wouldn't actually be looking at that sort of question directly. I think the other thing to bear in mind is that the sort of analysis and the sort of the comments that people make about this tend to be just about sort of tax revenue. And obviously there's a much broader issue about the economic performance and devolution, which people haven't really looked at. So has devolution led to better or worse economic performance, and what are the fiscal implications of that? So it's in the round, it's a very complex issue, and certainly the work that we did at Christmas shouldn't be sort of read as giving this interpretation.
Okay, thanks, John. So the next question is about recession. It's saying the Bank of England is forecasting a UK recession starting at the end of this year. Why do you feel that Scotland will avoid a recession in our forecasts? Well, let me start off with that one, and others can come in if they want to. When we were preparing our forecast, we did see the Bank of England's forecast, and we went through it very carefully to understand where their predictions were coming from. And there was nothing in their forecasts and their underlying assumptions that weren't in our assumptions as well. They were taking a view that the restrictions on supply chain disruptions would have a big negative impact on investment. And that's the bottom line of what seemed to be driving their view that the UK would be going into recession. Other forecasters took a different view, and we essentially took the forecast of the OBR for the UK economy as our central forecast when we're making a forecast. But it's just one of these areas where different forecasters faced with the same information can end up making somewhat different conclusions from it. Recession is a potential downside risk to our forecast, but we still thought as a central forecast, the best forecast we could make was one with very low growth, but not negative growth.
Yeah, I mean, I think just to reiterate the point I made in the presentation, in a sense, the question is less why our forecasts slightly different from one another at the moment. It's actually why are they not more different, given that we all forecasters agree that this is a really uncertain time for forecasting. So in a sense, the spread of possible outcomes is actually much wider than the spread between forecasts. You know, the difference between 1% growth and minus 0.25% growth is really, you know, tiny compared to actually the possible range of outcomes that we're looking at. So I would say that actually, you know, the question is more the other way around: is why are all the forecasts so similar to one another rather than why are they slightly different?
Yeah, thanks, Francis. Sorry, David.
And I was just going to add to that, the difference between our forecast and the OBR shouldn't be interpreted as us thinking that Scotland would avoid a recession if the UK were to enter recession. It's simply different forecasters with different expectations. In all likelihood, if the UK did enter a recession over the next year, Scotland would probably follow a similar pathway. So it's not a prediction of Scotland relative to the UK. It's just slightly different forecasts.
Okay, that's an interesting point, because the next question is about Scotland relative to the rest of the UK. So the question is, what is the most important driver of the divergence in economic growth between Scotland and the UK? Well, I'll maybe start off and others can pick up on this, but in an answer to a previous question, I pointed to a number of different factors. There were some regional factors, there were some sectoral factors, and those seem to be equally important parts of the story. For the longer term, I think there is an issue about relative productivity growth. we're forecasting a slightly lower longer-term growth and productivity than the OBR is for the rest of the UK. And I think that is one of the big challenges Scotland faces. But I don't know, David Stone, do you want to add anything to this?
Yeah, again, we'll be coming back to this later in the year in the context of income tax. I think the thing that surprised me, given the sort of analysis that we've done so far, is slow growth in Scotland off the back of a slowing of North Sea oil and gas inactivity, and also very strong growth in the UK in financial services, particularly in London. Those two are sort of seem quite important, but it's actually what's been happening with employment and just headline labour market participation seems to be at least as big a factor as either of those two, which seems to be partly related to demographics and partly related to other factors as well. So that's certainly playing a key role as well, and we're going to be trying to break those down and disentangle those different effects.
Okay, thank you very much. Our next question is an interesting one: is would a public sector pay freeze affect Scotland or the UK more? I don't know if you want. Francis, do you want to try answering that one?
That's a tricky one. I mean, I think David's going to correct me when I get this wrong, but I think that the public sector employment as a share of total employment is slightly higher in Scotland than it is in the rest of the UK. So there would be a bit of a relative effect, but I think that's a second order compared to the overall effect of the UK as a whole.
Yeah, I think that's probably right. Okay, the next question is, have you started work on forecasting the economic impact of Scottish independence? George, do you want to pick up on that?
Yeah, happy to do that, and very topical given that the First Minister and Patrick Harvey have been speaking about Scottish independence at the same time as us, the alternative attraction at the other end of town. So we've been thinking about Scottish independence and how we look at this for a while, and at the moment, I think what in a sense we don't have is any sense of when the referendum will be in real terms, and I don't think that changed from what I've seen of what was said this morning, and therefore it's very hard to think sort of what will happen. We don't know the terms of the referendum, and we don't know what the future will look after the referendum. We don't know the result, and we don't know what is actually proposed. So there's an awful lot of uncertainty here, and that doesn't really allow us to start thinking about independence and its impact. What we have started to do, though, is we've started to think about, well, given all that uncertainty about the future, what's the potential economic impact likely to be, and how would that affect our 5-year economic forecasts and our fiscal forecasts? And again, because of uncertainty about the date of the referendum, it's very hard to say an awful lot. So what we've started to do is we've started to look at the degree of uncertainty here. And in 2 publications ago, we introduced a political uncertainty index for Scotland, which is based on the approach that the Bank of England and others have taken to looking at economic uncertainty elsewhere. And we calculated that index, and it's sort of you can look back at it, and the results were a little bit surprising in terms of sort of about the degree of persistence in uncertainty around sort of the first referendum and also the Brexit referendum, but it didn't at that stage start really to pick up anything new about uncertainty in the future. We recalculated that index just before this forecast was published, and again, the backstory is exactly the same. It wasn't really picking up an awful lot. It started to pick a little bit, I think, which is around the sort of the uncertainty around Ukraine and Russia, but nothing so far seems to have been picked up. And I should say that this index is based upon sort of mentions of uncertainty and economic uncertainty in sort of newspaper coverage. So it sort of takes quite a broad range of things, and it produces an index on that basis.
Okay, thank you very much, John. That's really helpful. It turns out we've done a really good job, and we've answered all your questions, and there are no more questions coming in. So given that, I'd now like to draw this webinar to a close. Thank you all very much for participating in the event and for submitting all your questions. We look forward to welcoming you at our next webinar. On the screen, you will see details of how you can contact us. So if there was a question that you really wanted to ask and it has not been picked up, or if something occurs to you afterwards that you really want to ask us, please contact us and we will reply. Thank you and goodbye.